Hello everyone and happy Monday. Steve Gans back here to contribute some trade ideas from OptionStrat. What I want to do today is I want to kind of see what's happening out there in the market, get an idea as to whether or not there might be a decent trade to be had, or what are other people trading. So I can come in and I can look specifically at options flow. Now I find this to be pretty valuable, pretty interesting. But I come in and I can see on the options flow kind of what is flowing bullish and what is flowing bearish. Now, what's really interesting here when I first look at this is these two actually support each other, which gives me a stronger thesis or a stronger potential trade to base my decision on. And what I mean by that is gold often trades in the inverse of the big ETFs, SPY, IWM in this case, which is the Russell 2000. So if gold were just up by itself and then the Russell were not bearish at the same time, if we had bullish on gold and didn't have bearish on Russell, yeah, that's interesting. But the fact that these two are in sync with each other, that we've got a lot of people, it seems like, pushing up gold at the same time they're pushing down IWM. And what's really interesting is I look at this, take a look at this AA. So they are paying these people, whoever are making these trades in pretty sizable lots, they are paying above the asking price to get into these spreads. So that tells me somebody's got some fairly serious conviction about gold potentially going higher. And then let's come back and take a look at the same thing here, and let's see what's happening on IWM. And we have the same thing here. People are paying, in many cases, above the ask to get into these bearish positions. Okay, so there's a lot of things that are kind of aligning here. And again, we go all the way down here. There are, again, a lot of people that are pretty darn bearish here, which is why, of course, we've got this bearish sentiment on IWM and we had the bullish sentiment on GLD. So again, those two kind of go hand in hand. So if I were to want to look at making a trade in this, first of all, I have to decide how far out in time do I want to go? Do I want to be all the way out in June with this trade? Or do I want to be in April? Or, exactly where makes sense for me? So I like to stick a little bit toward shorter trades myself. So I might look at something maybe along this this bear put spread 170, 162, somewhere in that area. Seems like that might make sense. So let's take a closer look at that. And we can open this up in Visualizer. And this is what this is going to look like in Visualizer. So I will tell you that for my taste, looking at this particular position, this will require the market to drop quite a bit. I mean, from its current 174 or so here, all the way down to 168 in the next few days. Between now and April 21st, so about 3 weeks time frame. In my opinion, that's a lot to ask. I don't know that I would be personally that bearish. Again, a lot of these people out there are a heck of a lot smarter than me. But what I would do if I were to make this trade is I would probably come closer to the money with my long put. And I would buy my long put closer to the money. I would sell my long put maybe a little closer to the money as well, basically just tightening up this entire spread, making it a little closer to where the market is trading right now at this time. A couple things to note here, though, that I really like that OptionStrat does. One, you can see these bars. So this is telling me how much open interest or liquidity is at each one of these locations. I want to ideally trade where there is a lot of volume. That provides liquidity, gives tighter bid-ask spreads, allows me to get in and potentially out of a trade much, much quicker. Now, I can also look at all the stats here. So the net debit on this trade is going to be $193. And let me just do this. Let me make this 174 just for the heck of it. So it's going to be $232. And that is my maximum potential loss. It's what I pay for this spread. I could have a maximum potential profit of 556 if IWM were to tank all the way down to 166 and be down there or below at expiration. That's how I would garner this significant profit. Now, I can also look at all of my Greeks here. So I know that this is going to be a negative delta trade, which means that I need the market to drop in order to make a profit. I also know that it is negative theta, meaning that theta is going to decay. Theta is the amount of money that might come in on a daily basis on a trade. And if you had, for example, an iron condor put on around this, theta would be positive. So that would be working in your favor every day. The fact that theta is negative here, we can illustrate exactly what that means and how that works. If we take a look, this would be our trade if we entered it today, and this is how the price is modeled to work. These are all theoretical numbers. Nothing here is guaranteed. It's just a model as to how things might work. So if we entered this today and a day or two from now the market tanked, well, we'd be up, $58 or so in this trade. But if the market stays right where it is here, we are going to have what's called theta decay. We're going to see that over time, we actually lose money if the market doesn't change. That is theta decay. That's what's happening right there, is theta is decaying on us. And if the market does not move in our favor, that's going to continue to decay all the way up until we expire and we suffer our full loss, in this particular case, of 232. So that's why the negative theta. We're basically paying 68 cents a day to maintain this particular position. And I'm not going to dive deep on all of these Greeks, but that's kind of what you needed to understand about this position. Anytime you evaluate a position, you always look at where is your risk, where is your reward, okay? And then how much risk and how much reward. So again, here, our risk is the $231. Our potential reward is the $569 if you carried it all the way to expiration. Many people will not carry it all the way to expiration. If this trade drops or the underlying drops in value and this experiences some sort of a profit earlier on, many people will go ahead and take that profit at that point. That's an individual trader decision as to how they choose to trade these types of things. So let me just take a look at modeling this up. So if I model this up, I've modeled it here, 174, 166 in toss. It's going to cost me, as you can see, that $233 debit to get into this. I'm going to pay $233 to get into it. In order for this thing to make a profit, I'm going to need IWM to fall a certain amount, and then it becomes a profitable trade. So what I would urge everyone to do is go model this up in paper. Always trade things in paper first. Make sure you fully understand the risk reward. Or of course, if you're back in your OptionStrat platform, you can just simply save the trade and then watch and look in on that trade over the next days and weeks and see how it would have done. This is how you learn options trading, and you should always learn in paper and make sure you fully understand what you're doing before putting live money at risk. So all that said, the options flow is indicating that this is a trade that many other people seem to be making right now. But again, just because somebody else is making it doesn't make it a winner, but it is something that you should model and study. And again, take these trades in paper initially till you're comfortable. So Steve Gans providing another trade idea here to consider for OptionStrat.